so many people. That's how we can tell this is a topic that everyone struggles to understand and don't have a right resource. We will answer your questions even if you don't get to it through emails or through videos. Just follow us on social media. You'll see all these answers if we don't get to them. And even if we get to them, this will be recorded. We share a lot of information on social media and we are doing a lot of production this year. So please follow us there and all of your questions will get answered there. This is a legal matter. So you make sure you have a legal expert in your team as you're scaling up. If you do not have a legal expert, it's okay for now. I'll let you know how to get started, the most simplistic and non-harmful way. And I say this because people will go full board and get bunch of corporations and LLCs when they don't need one, and their compliance cost goes extremely high, which is not good. All your cash flow from real estate and business, especially when you're starting out, will just go away. Do not do that. Understand what I'm saying? Then it will get you started. But once you have a cash flow, you can always hire an attorney and CPAs to go through this kind of a detailed conversation with your professional. Now, I'm going to share a few things on my screen. If you email us after this, we'll send you Excel or PDF. We already have emails. We'll send you those things so you can build on top of that after the call. So don't feel rushed and everything. If you understand what I'm saying today, the good news is we are launching a tax planning software. We're going to probably launch next year. If you understand this now, you can do your own tax planning. Meaning, for our clients, we charge people, I think, $7,000, $8,000, $9,000 for tax planning. It's expensive because it takes a lot of resources. However, if you understand that concept, or if you have been engaged with us before and we have explained you some of the concepts, and we're going to send you 100 guides this year, you understand the concept, you can use the concept to do your own tax planning for $500 next year in this AI software. It's going to be very good. And if you follow us on social media, you will see when it's going to launch. If you reach out to us, we'll probably give you a beta version for almost free just to test it out, just so you know. So with all that being said, let's talk about all of these LLCs and corporations and how to get your first LLC, how to structure them, and what to do. That's what I'm going to focus on today. So let's get started. I want you guys to understand this. This is a very interactive meaning I will be sharing a lot of screen. You guys cannot talk. It's not that interactive. But if I just start speaking about LLCs with my hand gestures, you guys will not follow. So I'm going to show you this on my screen. And I'll stop here if you have to say something, okay? First thing everyone needs to understand, if you're involved in real estate, because we specialize in real estate. We have a bunch of business owners. Okay? We have plumbers, doctors, restaurant owners, and they invest in real estate and they come to us because we specialize on that. Once people get in real estate, they do not know how to structure their real estate, rental properties, flippings, agent, doesn't matter what it is. They'll try to put everything on the entity they already have, which is not a good idea. You don't want that. And sometimes it hurts you. Example, we had this prospect who came to us and she was saying, oh, I have this kind of structure, I have this real estate. And I told her saying, hey, you cannot be having this structure. I know how real estate works. I knew you want to cash out on these properties. It's going to hurt you. And I don't think we ever got engaged with that client. Engaged call back 6 months ago. She was crying. I'm not even kidding when I said she was crying. She was paying, I think, I can remember the number, $392,000 in taxes, which she could have avoided with the right structure. $392,000 on refinance of the property, which should not be taxable. But if you get a wrong entity, it will be taxable, is what I'm trying to tell you. That's a mistake. You don't want to do it. It is worth paying your professional few $1,000s to set everything correctly so that you don't make that kind of mistake as you grow. And everyone wants to grow. Everyone wants to scale up, right? Building a right foundation since the beginning is one of the best way you can plan for your LLCs. Okay, I know I said a lot of things. We need to give you a basic understanding of how these entities work, because the biggest confusion comes to a lot of people and even CPAs is they don't understand what's out there. People talk about trust, C corporations, S corporations, partnerships, right? All of those things. And they might be thinking, oh, there's so many things. I'm not sure what applies to me. And if there's too much information, you just don't even bother to investigate. That's what kills most people. I'm just trying to give you very high level information. These are the only relevant entity structure that applies to you as a business owner. And then you build your knowledge on top of this. I'm going to share my screen now to show you. What in my screen is our tax planning module. We have 300 tabs in here, 300 strategies, not even including states. This is why we are converting this to software. You'll have access to this. Don't worry about this as we launch the software. But right now, just focus on entity structuring. What I'm showing my screen, understand how an individual can own their businesses and real estate. For 99% of people, this is how it works. 99. Don't try to get into C Corp unless you are building a tech company, you have plans to sell your company. It applies to a very small amount of group of people. It might be relevant, but applies to a small amount of people. Most of real estate, it doesn't even apply. If you have non-real estate businesses that you plan to sell in the future, most of the time you're just reinvesting everything in the business, then you can get a C Corp. And we can talk about your investor, your advisor can guide you through that. But most of the time, C Corps are Amazon, Delta, and Apple. Okay, people buy shares of the C Corp. You don't need that most of the time. If someone tells you to get a C Corp, run away, is what I'm trying to tell you. I know very advertised people on YouTube, and I don't want to take their name. We get the clients from there, and they have C Corps. I was like, why would you get this? And it takes them from 10, 15,000 to restructure that. Do not buy the hype, understand, and then you'll be fine. So if you don't get a C Corp, you have only 3 things remaining. Super simple to understand. Follow the color code. Red means you need to file a tax return. And why is that important? Because it costs money. When you file a tax return, we charge people $2,000 for basic tax return. If you go and randomly get 5 S Corps and 3 partnerships with your colleague and your friend and even your spouse, just you have a 5 entity that you don't need. That's a $10,000 you're losing a year just to file a tax return and annual maintenance fee and so many other expenses. But all of that. I'm talking about just filing a tax return. Do not get LLCs, S Corps unless you need it. And honestly, you need it legally and from tax perspective. And that's what we're going to touch on today. Green means no tax return required. So when I say no tax return required, it gets reported in your individual tax return, which is also red because you have to file your tax return at the individual level. So if you have no entity, you just go open up a food truck without any legal entity, or let's say you go and get an LLC, but it's 100% owned by you, not your spouse, and if you're married. It's a single member LLC, then it's disregarded. That's the word I want everyone to understand. It's called disregarded entity. Disregarded entity means it does not even exist in the government eyes. It's disregarded. That's what the green single member LLC or no entity, you get nothing. And it gets reported to your individual tax return, which is easier to report. People charge you $300, $400 to report that entity versus $2,000 on the other side. So understand that first. Which one should you be getting depends on what you're trying to do. And I'm going to explain that next. Okay, I'm going to share my screen again. So in this screen, I want you to understand when to get what. I will repeat this again, but for most, this is how you should think. If you have a rental real estate, I'm talking about long-term rental, commercial property, short-term rental, any kind of the rental real estate operation, you never get an S corporation. Never. Unless it's a very specific situation. You're selling your own primary residence to your S corporations to get that exclusion. That's another planning strategy. I'm not going to go over there. But there are situations, applies to a very small amount of people. If you're just buying real estate, rental real estate to invest in real estate, you're never getting an S corporation. You're either getting multi-member LLC or a single member LLC, depending on who you are working with. That's the first thing you need to understand. Second thing you need to understand from my screen is, when are you supposed to get a multi-member? You are never supposed to get a never is a very strong word. Depending on your legal risk, it changes. But most of the time, please do not go and get a LLC and go have you and your spouse as a member. If you're single, you never have this problem. As a married couple, never go and get an LLC and I want my wife to get involved in this because she wants to be part of this. Don't do that. There are other ways your wife can get involved. I'll show you that later on. But do not go and get LLC and add your spouse to an LLC. That automatically creates a partnership filing tax obligation. It's a 1065. You have to pay $2,000 to file it. You don't want that unless it's needed. And the other thing just to talk about this is this. For rental real estate, LLC never saves you taxes. Again, to repeat, okay? For rental real estate, LLC never saves you taxes. Getting a single member LLC doesn't save you taxes. So if you get the LLC structure right for rental real estate, it does not save you taxes most of the time. But if you get it wrong, it's cost you money. I gave you an example before. You get it right, it doesn't save you too much money. Okay, it's just a legal entity. But if you get it wrong, though, you're going to pay that $300,000, $400,000 taxes in the same situation that the other lady had. So just to recap this, you're never getting S corporation or C corporation for your rental real estate. I did not talk about agent or flipper or wholesaler. Rental real estate. You're never getting a corporation unless your tax advisor deems necessary. You're never getting a multi-member LLC with your spouse unless your attorney says so, if you have legal implications. If you want your spouse to get involved in your rental real estate, there is a way without a multi-member LLC, which I'm going to show you next. Now, when I told you earlier, I'll give you the easiest way to start with LLCs. Doesn't matter if you do rental real estate, flipping, wholesaling, other kind of real estate, or if you open any kind of other business. Always start with a single member LLC. It does not complicate your taxes. It's disregarded. It doesn't exist in the government eyes. So the government ignores it. So you're never, it doesn't complicate your tax situation. Sometimes what happens is your bank will ask, okay, you need to have an LLC or you need to have a legal entity. Don't go and get an S Corp or C Corp because someone said so. Get an LLC. You can always convert it. I'm not even kidding when I say this. This is how flexible this is. You get an LLC, single member LLC. Once you open a bank account, once you get your paperwork signed up, you can convert. Don't even have to change the name. You can convert the taxation of the LLC into C Corp, S Corp. You can even change that to multi-member if you want. So that's the safest and easiest way to get started. Get a single member LLC. And you can do it so easily online nowadays. You don't have to work with attorney. Do work with attorney, but if you're in a hurry, don't go get an S Corp or C Corp. So that concludes the first portion of our webinar. Where to explain how many entity, what kind of a relevant entity exists. So I'm going to stop now and see if you have any questions, which we have some, I'll answer them, and then we'll move on. Someone asks, okay, if you're just starting out and you're doing wholesaling, what should you get? Is someone asks. The statement I made earlier still applies. You're going to go get a single member LLC. Then you're going to tell your CPA or your tax advisor, hey, I'm going to end up making 60, 70, 100, $200,000 this year. So what do you recommend this to be taxed as? And then you go and change this to a right kind of entity structure. Do not just go and create a random LLC. It is going to hurt you more than help you. That's the first thing. And we have a bunch of other questions we'll answer at the end. And it's very dry. This is why people will work with an attorney and then pay a lot of money because no one wants to do this. Okay, let's move on to our... So what I've showed you earlier was how to understand what's going on. Now I'm going to show you very basic. It applies to most people, how to structure, I'm going to share my screen, how to get the right entity structuring. And you can go and take this to your attorney. We'll give you this Excel, this file. Just make sure to do this. You go ahead and take this to an attorney because attorney will charge you $2,000 just to draw up what I just drew. If you want to save $2,000, say, I already have a basic structure I want to use and move from there. You can always say that and show them, okay? So if you see in my screen, I drew this up. This is what we draw to our clients. It has a holding company, branding, and property management. We'll go through all of this. I know there are a lot of colors here. I try to make it as easy by dividing the activity in the bucket. And then if you need to file a tax return or not. Red means you need to file a tax return, and green means you don't need to. Normally, from tax compliance perspective, you want to be as green as possible because it saves you money. Red is basically when you need to file a tax return. There's a specific situation, and I'll walk you through that. One of the questions we had, and I'm going to answer the question first because it's too much information. Someone said, I invested in real estate first, no entity, and want to start a medical practice. Single provider approach for now. In Texas, how should we set up the entity structure? Good question. Remember, real estate should never get commingled with your medical practice or any other restaurant or anything. So two different issues. Your medical practice, the state and you're in a medical license board has different kind of requirements. Sometimes you need to have a corporation to start with, like California. Texas is different. So you would start again, you're going to start with single member LLC if you want to starting it out, because there's no point being an S corporation, running a payroll, which is required for S corporation, and paying salary and setting up QuickBooks, all of those without actually making money. So first year, most of the business don't make money. Get the LLC and see how much money you're going to make. If you know you're going to end up making 200, 300, or even $100,000, you can retroactively convert the LLC for your medical practice into an S corporation and get all the benefit anyway. So why go and create an S corp since the beginning and run a payroll, file a tax return when you have a loss? It doesn't make sense. So talk to your provider, a tax advisor, and they will help you better. For real estate, same concept. Get an LLC and you're going to be fine from there. Another question I have is, is it best to sign up for a holding company before setting an LLC for each business of property? Normally, yes. And I'm going to go through that structure in the next few minutes. And we're going to answer all the questions after I go through this next phase of webinar. I'm going to change my screen to the relevant tab. If you're married, perfect. If you're not married, still applies. I know you can see my screen. Do you see this holding company on here in this green? Green means no tax return, right? Do you see this trust in here? I want everyone to understand this. If I remove this trust, if you don't get this trust, and these two individual, husband and spouse, gets this LLC together, holding LLC in Wyoming or Nevada and Delaware, doesn't really matter. You get a holding LLC, two of you own this directly. When two people own LLC, it becomes a multi-member, not a single member. This changes to red, and then you have to file a tax return. That's 2,000 rupees down the drain. And holding company, you don't want any operation anywhere. Holding company is for like a legal, it's not for tax savings, it's for legal reasons. And most of the time, you don't want to file a tax return for that. So how do you get around that is what I'm going to show you next. Very important for married people if you're ever going to get married. If you're going to get a LLC with your spouse, you want your spouse to get involved, you need to add a trust in between, like I saw on my screen. So on the top here, two of you are going to sign this trust document. It's a one-time cost. And it's also green, meaning it doesn't need to file a tax return. You don't even need to register this with the state. Your attorney will do this. And someone asks question, where does a trust go into any of this? It's exactly what I'm talking about right now. Living trust. There are 100 types of trust. I'm talking about living trust, which doesn't need to file a tax return. It's a piece of document you sign and you save in your bank account, and then something happens, it triggers, it becomes irrevocable. If you have a living trust in between your holding company and your individual names, then it solves that issue I said. This holding company becomes single member. You don't have to file a tax return. One of the mistakes I see a lot of investors make it, now they will start operating through their holding company. They will bank account, they'll start writing checks, they'll start contracting with contractors, and if they're flipping a house, they will buy materials to holding company. They will never do that. It defeats the purpose of holding company. You want it to be anonymous. You just hold your asset. Then you have other operating entity below that. So when someone asked me, hey, should we have a holding company before other entity? Sometimes yes, and here's the reason. Again, another layer of legal implications. If you get bunch of LLCs, which a lot of people do, let's say you own a rental real estate, or you start flipping and you get an S corporation, and then you create an S Corp, or you create a rental real estate LLC, you go and invest in real estate. And then after talking with the advisors, you go and get a holding company. What you have to do is you have to go to the state and change the ownership of that holding on S Corp to your holding LLC now, right? The problem with that is most states has that historical information, who owned the LLC before. The whole reason we want a holding company to be anonymous. Everyone understands this, right? When you create an entity in Delaware, or let's say Wyoming, it will never publish who owns the holding LLC. So you have a holding LLC and you own a bunch of other LLCs, operations, or $1 billion industry. No one will never know you are the owner. However, though, if you don't follow the steps, meaning you get the $1 billion industry first with one LLC, and then later try to move that to holding LLC, the historical information is presented by the state, and you lose being anonymous. That's what the foundation needs to be correct, is what I'm trying to tell you. There was like a brochure or a note in the mailbox saying, do you want to sue your landlord? Text me. Not even email me or visit my office, text me. That is how easy it is for your tenants to, if they're not happy, if they piss them off, I want to sue. They might not even win, but it will cost you money to defend yourself. Your insurance goes up. If they text your attorney and say, hey, I want to sue, and yeah, please send them a legal letter. That's $100 for that, because the attorney has a template. You just put a name and send it, boom. You get a legal letter, that you have to hire an attorney. Then you have to go to the court. You lose $5,000 just like this. You know how we can defend that? Get a holding company. When your crook tenant texts the attorney saying, yeah, I want to make my landlord's life miserable. Your attorney go and looks at the structure. If it's anonymous, they don't know who owns this. This might be Trump, Jeff Bezos, or Biden might own that property. They don't know that. So they don't pursue that kind of, they already know have legal help because you did it correctly since the beginning. Enough scaring. All I'm trying to tell you is have a right foundation and you guys will be fine. Understand the operation as well. Creating LLC and not following the rules will not help you. Okay, back to our track. Spouses owns living trust, also holding company. If you're not married, then you don't need a trust. You can hold a holding company directly. It's always going to be a single member LLC because you own it. But if you ever plan to get married, then setting up the trust since the beginning helps you. And you can always add your spouse to a trust. Now, I hope everyone understands the holding portion on the top, up here. Let's go at the bottom. Ignore this branding, ignore this property management. We're just going to focus on this 4 bucket today. And we might go up here. These are the 4 buckets that most investors care about, are involved. One is you invest in other people's deals like syndications. right? You get K1s and stuff. Other one is that you invest with your colleagues and friends and families, and your brothers, siblings. That's the one way you do it, to invest in real estate. Other is you own this 100%. And although this is non-passive, remember, these are all, real estate mostly is passive, and other is non-passive, and people call it active, which is not correct. Non-passive and passive. Passive is mostly long-term real estate, and non-passive is anything. You do a 1099, you're a consultant, you do retail, you have an Amazon store, you have restaurants, you do wholesaling, you do flips. Any business is non-passive. It can be easily non-passive, and rental real estate is passive. So I'm trying to separate this out. I'm going to go with the easiest things first so you understand. If you are investing in syndications and other people's money, go to invest in your name or your holding company. If you have one name, your trust, doesn't really matter. Go invest through that. Do not go invest through your S corporations you have for your agent. Do not invest through your partnership with your brother. You invest through your name or your holding company's name. You have to be legally protected or whatever you want to call it. Okay. That's one bucket. Easy to understand, no big deal. You can get even a holding syndication LLC, and you can have multiple interests like this. Better way to organize your portfolio. Even if you don't get this, even if you don't have this, you can directly invest in the K1 like this through your holding company, or like I said, directly through your name, like this, from the top, or through living trust. No tax difference. Okay, I know we are a tax planner, so we are not attorneys. I'm not trying to give you legal advice. I'm saying from tax perspective, everything is green. If you look from the here, living trust is green. This is green and this is green. Doesn't matter if you get 100 different LLCs in between, 100 different holding companies. There is no tax implications. It's always, and the same, your tax doesn't change. There's no extra filing either. You might have some state filing requirement depending on which state you live, but no federal requirement. That's one easy things to get out of your way. The second one is this. This is something you need to understand. There's only two things I'm gonna say, which applies to you guys. And so many people make these mistakes. One is, I already mentioned this before. How are you structuring this with your spouse is the first thing. Do not go and create. This is exactly what I'm showing in here. If you go and create, it becomes red. As soon as two people are involved in LLC, it becomes a multi-member and you have to file a tax return, which is red. You don't want that. When do you want it? When you have a non-spousal partner, your neighbor, your siblings, your parents, your colleague, then you need to get an LLC for legal reasons, which your attorney will say. What people don't understand is this. You go buy a property with your brother, you don't need an LLC to be a partnership. It's already a partnership. LLC does not drive tax filing requirement. You already have a partnership. It's called general partnership. You don't have a limited liability protection through LLC, but it's a general partnership. Everyone needs to understand this. Oh, I'm not going to get LLC, so I have to file a tax return. That's not correct. You have to file a tax return as soon as you create a partnership. You don't need an LLC to be a partnership. You shake hand and open a restaurant, it's a partnership. You're going to have to file a tax return. You can legalize that with LLC. That's what this bucket is. So two things, right? Do not get any spousal partnership unless you need one. Through your attorney recommends one. Second thing is this. You meet with your brother and open up this other rental partnership. You do this. Both of you guys want to invest in real estate. And you buy one property and two property like this. Now you say, you know what, we're doing great. Let's buy 3 more properties. Please do not go and create another red LLC on the top. You can add 100 different LLCs below the top level LLC to your partnership. Even if you invest in multiple states, have one red, meaning one tax filing obligation, and you can have 100 LLC owned by this one LLC on the top. So you have only one tax filing obligation, even though you own 100 different LLCs. Even though you have 100 different states. If you go and create multi-member LLC that red for multiple states, if you invest in 10 states, 10 different tax filing obligations, and you do not want that. What you want is one red like this and everything below like this. You can have multiple LLCs below like that. I know it's a lot of information, guys. Just to recap what we said until now is, do not get a holding member LLC with your spouse, add a trust in between. Syndications, doesn't really matter how you hold them. You'll be fine. It doesn't change your taxes. This is what impacts. This is the first point that actually costs you money. If you get a multiple red entity, this multiple multi-member LLC, this is what's going to cost you money. Do not do this. This is what I'm trying to tell you. Okay, I'm going to stop now and then check on you guys because it is complicated. I see a bunch of questions. So I'll answer them later on. We have 2 things remaining. Okay, we talked about syndications. We talked about how to own real estate with your brothers, sisters, and everything. Just to recap, never owning real estate. Even if you go buy a property with your brother, you're not getting an S corporation or C corporations. We talk about this. If you already own medical practice, if you already own a flipping company, if you are already a real estate agent, you have a restaurant, you're never using those entities to buy rental real estate or hold your syndications, never doing that. I think everyone understands that so far. We're going to wrap this up with this next two bucket, and then we're going to answer a bunch of questions. So let me share my right screen. So the next bucket is 100% owned by you. Very simple. As you can see, everything is green. You want most of this to be green. This section, everything is green. See that? Meaning there's no tax filing at the federal level. There's no tax filing obligation. You get a living trust. You have a holding company, which makes you anonymous. And you can have a rental holding company. This rental holding company can own multiple other LLCs in multiple different states. And this LLC can own multiple properties or single properties, depending on your risk and your profile that your attorney is going to recommend. It's all green, meaning you're not filing any tax return. Unless your attorney says, hey, convert this to a red by adding some other limited partners for legal protection. Sometimes they do that, and sometimes there might be a reason for that, okay? But do not just randomly get it. Because most attorney makes more money by filing a partnership operating agreement, by filing a partnership stuff. And you also have to remember, unlike accountants, lawyers get one-time business. They set up your entity structure and they move on. So they don't care about your long-term well-being, unfortunately. Accountants do. We work with you year after year, try to save you money, and we don't want you to lose $2,000, $3,000 and filing extra tax return. We don't need one. I've seen other CPAs will never bring this up, and they might actually even ask you to create a partnership because we make money by filing partnership tax return, extra money. We're not that greedy. We want you to save money, okay? So I'm telling you, I have clients who came up with me with a 10 different partnership return which never needed. If I had kept him all those LLCs, which he did not need, and charged him $2,500, I'll be making $30,000, $25,000 just by not changing anything. People do that. That's what I'm trying to tell you. We do not do that, okay? We care more about you than that $25,000. So you guys understood this. Next is, this is the only area where LLCs and S Corp will save you money. Everything else I've said so far does not save you any taxes in rental real estate. Just to repeat myself, no tax savings comes from rental real estate. Now in this section, I'm showing you non-passive income is where even a normal LLC can save you taxes, like a spousal LLC or S corporation. And I'll walk you through that next. So what do I mean by non-passive? Said this before. If you're in tech industry, you're doing consultant, you're a landscaper, you're in wholesaling, you're in flipping, whatever you do, you're getting this structure. Let me explain this. You're going to get an S corporation. Most likely, this S corp is going to own your multiple other non-passive business. Repeating myself. Do not get 10 different S corporations if you have 10 different non-passive income source. If you have 10 different restaurants, you're not having 10 different S corporations unless required by attorney. You can have a one S Corp, which is red, and they can own 10 restaurants or 10 Amazon stores or 10 flipping entity, 10 wholesaling entity with one S Corp. So you're not filing 10 different S Corp tax returns, because having 10 different S Corporation and having one S Corp that owns everything is exact same tax savings. Actually saves you more money. S Corp has a lot of compliance issue. Filing tax return, running a payroll. You have to run a payroll. And this costs you money, monthly money and yearly money. You have to file payroll tax returns. Do not get multiple S corporation. So how this S corp works is, let's say you're a doctor, you have an S corp. This S corp can actually own your wholesaling and flipping business. Or if you invest in restaurant, you can own one. You might not want to do that because of the malpractice issues. Your attorney will walk you through that. But if you have a non-passive income source, talk to your CPA, because this is the next point. Your spouse wants to get a rep status to not pay any taxes. Your spouse gets into real estate, starts flipping, wholesaling, or being a real estate agent, does not automatically make you a right candidate for an S corporation. You need to hit a certain threshold for it to make sense. And we walk you through that. And I'll show you a very high level number of what that is in the next few minutes. And then once your CPA says, okay, you're ready to get S corp, then you're going to get an S corporation. So if you're a flipper and if you partner up with someone else to flip a property, this S corp can be a partner in that flip, and other partners come as a partner. Do not create another S corp for the flip. I know I said a lot of things, guys. It is not very easy, and it's very general. You have your own situations. I understand. What I showed you on the top basically applies to everyone. You just mold this to your need. We'll give it this. You can make your own structure. Take this to an attorney, say, hey, implement this. Okay, we'll send you this. Down below is if you're gonna ever open up a fund and you start investing at GPs. We're not gonna talk about that today. If you need that consultation, please email us or work with your advisor. We'll walk you through that. Always get your structure approved by your CPAs before you sign with your attorney. Like I said, attorney don't always understand taxes, and you guys know this. So I'm gonna stop right here and I'm gonna answer some questions. Someone is asking me, hey, my wife is gonna be a real estate agent this year. to get a rep status. And how do I know when to be an S Corp? I'll walk you through that. I'll give you a number. Very valid question. Everyone needs to understand this. Short-term rental, although they are treated differently for tax savings loophole, it is still a rental. So everything I just said for long-term rental still applies for short-term rental. No C Corp, no S Corp, still going to be in there, and the structure I showed you before. Okay, so always get that same structure. One thing with short-term rental, I do really want to say this is from audit perspective. And we went to some audits, we fought and we won. We won, but it took us 3 months. The client paid us $5,000 to defend them. You don't want to go through that. The easiest way to solve that is get one LLC, the way I showed you earlier. Get one LLC, put everything under one structure so you can count as a one legal entity. It solves a lot of audit issues for you. If you don't understand this, we have videos on our YouTube. You can go and watch that again. It repeats the same information. And email us if you have any questions. I know we're almost done, but I want to walk you through this. When should you be an S Corporation? When is the right time if you are getting an S Corporation? So I'm going to share my screen again. It's going to be very high level, guys. It's going to look complicated. Just focus on things I'm going to show you. Let's say Megan and spouse. You live in Texas, no state taxes. And then let's say Megan makes 100 and maybe more. And spouse has no W-2 and wants to do full-time real estate. And I want to show you here. Let's say you make $80,000 or maybe even let's say $100,000 to an S Corp. Again, S Corps can be medical practice, can be anything else. Okay. When is the right time to be an S Corp? This S Corp analysis. I'm going to walk you through this really quick. I'm going to show you this. I know it's a lot of information. You don't need to digest all of this. It is complicated. But these are our tax planning modules. It's complicated. Okay, that's why we're converting this to a software. So let me go through the S Corp analysis. Understand this and you guys will be fine. If you get an S Corporation, your CPAs will be doing this, is what I'm trying to tell you. Do you see this net tax savings of $25,000 up here? Ignore all the numbers and it's complicated. That's what S Corp is saving you. If you're not S Corporation, you would not have that. $25,000. When you're making only $100,000. But see how it changes. I have $25,000 per spouse. If I remove the $25,000, tax savings go down to $19,000. If I change your salary to, let's say, $15,000, tax savings goes to $18,000. So paying more actually saves you more taxes. If you go to your CPAs and go online, they will say pay as less as possible. Please do not do that. You need to go through this detailed analysis of how much salary should you be paying yourself. If you pay your CPA $1,000 to do this analysis, it saves you an extra $6,000. That's a 600% return. No kind of return can give you 600% in the same year. That's what tax planning is. Tax planning is basically someone is selling you a $100 bill for $1 or $10. That's what tax planning is. Please pay for tax planning, work with the CPA, and it will help you more than you think. Let me answer this one question before we end this. How do I get a holding company? Getting a holding company is no different than getting any other LLC. It just happens to be in a different state, like Wyoming or Delaware. It's just same process. Your attorney will help you if you work with an attorney. If not, legal Zoom. Just go and say, I want to get an LLC in holding in Wyoming. Like I said, when you get the holding company and when you go apply for SSN for LLC, do not do multi-member, like I said before, to get a single member, sole proprietorship, okay? We have so many other questions, which I'm not answering them because it's very specific to people saying, hey, I make this much money. It's impossible to run your tax planning in this call. You can email us and we'll help you out. So a few things before we end this is we will share this online. Follow us on social media, YouTube, Instagram, LinkedIn, wherever your platform is. You can find us in our website is investorfriendlycpa.com. If you go there, there's free consultation, book a call with Julie and she will walk you through our process. Pay for tax planning. So even if you want to do 1 hour call with us, it's worth it. We'll look at your situation. Understand this year and next year, like I said, when the software launches, you do your own tax planning. That's okay. I'm done. I don't want to complicate this anymore. It's already so complicated. Everyone, thank you for joining. Hope this was helpful. We'll do more of these, so keep on looking out on the social media. Thank you again, and we'll catch up. Bye, everyone.